I have 1 minute after here, so I'm going to go ahead and get started, folks. Again, I want to thank everyone for coming on board today. We had a lot of interest in this one. And, it's weird. I've done so many topics over the years, and even having sold over 600 long-term care policies myself, I ran into this particular objection. Can I self-insure? So we really haven't done a webinar on this, and having putting this together, work on this the last couple of days. There's a lot of moving parts to self-insuring because there's so many ways that people look at doing that. With the hybrid products and annuities. So I'm going to come around to that towards the end. But just to get started here, well, first of all, let me do some housekeeping. And my name, of course, is Jeff Clark. I think we have a picture of me here coming up in a second, but um, GoldenCare, 800-842-7799. I want you to remember that number because anything you see today, any thoughts you have, clients, any prospects you think we might be able to help you with, remember that's the number. We're all here ready to help. We've got a great marketing team. We've got myself, Manny, and Morgan. We've got all kinds of great marketing tools at goldencareagent.com. Some of those are listed up above, our InstaPivot tool, our LTC CEO, our CSG Strategision, perfect portfolio of products, underwriting concierge program. Anything that you guys need out there, we're here and able and willing to help. And so all we are is a phone call away. And don't worry about taking a bunch of good notes here or anything. Everyone's going to be sent a copy of what we talk about today. So you'll get that probably tomorrow and a copy of this. And the other thing I like to say before I get started is, listen, we love helping agents out. That's what we do. We want to make you guys successful. We want to help you. We want to put the tools in your hands to help you help and meet and get in front of as many people as you can and be successful out there. So it all can't start unless you have a contract with us. We have lots of products here, some 80 carriers and some 600 products, but all you have to have is one product with us. Okay, and what that gives you basically the keys to the castle. You can have all of our marketing goodies are available at goldencareagent.com. But you can't sit in the fence. At some point, if you have a prospect, it's important to get contracted so you're ready to roll. And so I encourage you, if you haven't had any of the products with us, get contracted so you're ready to roll. All right, with that, let's take a look at Morgan, Manny, and myself. This is your team, your regional directors. Myself, Jeff Clark, I've been here for, I guess, 29 years now. Manny and Morgan have been on here for several years now. They came from our marketing support and new business teams, so very well versed. But we also have a full team behind them that I'll introduce at the end. We've got our marketing support. Lynn Voss is on here right now. She's one of our best marketing support people out there, helps us with so many things. But we've got a whole team of people with Corey and the rest of the team, Renee. And so again, we are a phone call away. We encourage people to call us. We love helping our agents. So, okay. So before we get started on any type of topic, I always start out with saying the long-term care need is still there. As a matter of fact, post-COVID, we had those things where people didn't want to go to a nursing home, and 61% of people surveyed say they'd rather die than go to a nursing home. It's important for people to age with dignity and stay at home. It's never been more important. 90% of married couples are going to require some type of care. I always told my clients, look, this isn't a question of if you need care. It's when you need care, how are you planning to pay for it? So again, these are just facts out there. And I as evidence of this, we have our lead generating websites out there, and people are researching, looking for information. I can tell you that these websites have never been hit harder than the last couple of years. There is a growing demand. It's always been there, but post-COVID, you'll be surprised if you go ahead and introduce extended care to your clients. You'll be surprised at how much they want to hear about it. They'll be very receptive because they're basically waiting. 80% of adults have never had a real discussion about it, and like 90% of them want to. And so you'll be well received if you bring this topic up. GoldenCare will get you geared up so you're ready to do that. So just want to give you some encouragement out there that there are people out there, and there's really a lack of experienced extended care agents to service all these folks. So, okay, with that, the buying process. So yeah, we're going to talk about objections a little bit. Of course, lead down to the eventual objection of, can I self-insure? But, like anything, we have to create a need. We have to see if the client likes the product. Can they afford the product? Do they need the product? And so need creation is something that's always going to be around in every sales pitch. And you know what? You're going to have objections. But, I'll tell you, most objections, the first one or a couple are just kind of smoke screens. They're a little apprehensive. They're not sure. All right. So our job, of course, is to do that. And as far as objections, I always told my agents, a lot of these objections you can kind of eliminate before you get started. First of all, health and underwriting. We have a pivot presentation I'm going to talk to in a little bit here. But as you're going through, you have, if they're telling you they got some health concerns, well, we want to pivot to maybe a short-term care plan or a home health care plan, or so you have to be ready to kind of pivot, move around. So you want to kind of get some of those objections or problems out of the way. And sometimes you'll come to an end of presentation, the clients will tell you, I really got to talk to my children before I do this, or I got to talk to my daughter. So I always like to try to maybe ahead of time just ask them now, do you make the decisions yourself, or do your kids are they part of your decision making? No, no, we do all of our decisions ourselves. Well, that way I'm not going to run into that. Well, I got to talk to my kids first at the end. So little subtleties like this. Price, of course, you can design a plan that could be as little as 50 or as much as 600 a month. So we want to talk about price, affordable. So all these things can be flushed out. They're pretty common in the sales process. Another one is that risk. I love this. We have this as a walls of your estate in our PowerPoints or our missing link. But people have no problem with car insurance, homeowners insurance, and health insurance. When you look at the odds of these things, so the odds of your house burning down or being destroyed by a tornado is 1 in 1,200. Yet you know what? Everyone's got homeowners insurance. They wouldn't think of not having it. Odds of your car being totaled, about 1 in 200 or 5 in 1,200. Odds of being hospitalized with expenses exceeding 10,000, about 105 out of 1,200. Then you look over here at long-term care. Needing some type of extended care, married couples, 90%, 840 out of 1,200 are going to need it. Think about this. This is by far and away the largest risk facing any retirement out there. It's not even close. And yet it's ironically, it will take your cars, your house, your bank account, everything. And so it's just kind of reprioritizing what we're insuring. We probably would like to insure the things that are most likely to happen to us first, and maybe the ones that are least likely last. But we kind of seem to be backwards in this country. A lot of folks just don't want to address this long-term care thing. Okay, so as far as objections go and creating the need and establishing, affordability and, any issues they might have, I really suggest that you do use some type of a presentation. Now, we've got a great one called Missing Link. It's been used for 25 years, sold millions of long-term care premiums over the years, short-term care, extended care plans. It's been, updated, changed. It's had gone through many changes over 25 years, but it really is a great track for you as agents to run on. It'll help you kind of overcome a lot of these objections. We also have the pivot presentation. This one's got like a whole library of resources in there. So as you're going through, you're asking health questions, you can click different parts of these ABC blocks. So if they answer a couple of questions, we click a different area and the presentation pivots. It goes down a different path based on the questions they're answering as you go through. And then inside that thing, you've got access to, tax questions or, underwriting guides or anything you could possibly imagine, spend down, Medicaid thing. So anything they might hit you with, you've got a nice little resource that makes you look real smart. So if you don't have if you're not using a deck of any kind or a presentation, that's one of the many tools that GoldenCare will share with you. Okay. So again, objections. Normal making a bad decision. They don't understand it. They don't want to, there's a lack of urgency out there. All these things are things we're addressing. And so essentially what we're doing, it's part of the process, is we have to be able to handle these common objections as they come up. And here's some of the pretty common ones that we do see. We'll see, my family will take care of me, or my, Medicare is going to cover this, the government's going to cover this. These are all common, objections that we have plenty of arsenal of answers for why that doesn't work. But this last one here, can I self-insure? I remember beginning my sales process. I don't know. I think I started in, this would have been 2000, somewhere in there, or 97, I think, when I was in the field. So, just kind of starting out, I wasn't real well versed in long-term care, but I'd walk into a house and I would create the need, and they kind of agree with me, and they'd say, but look, Jeff, I've got like $2-3 million in the bank. I've got a great pension. I've got good, if I needed $250,000, I'll just pay for it. I don't see the need for the insurance. And honestly, when I was a young, inexperienced agent, I didn't really know how to handle that. I'm like, yeah, you're probably right. You're not going to lose your farm, or you're not going to lose you're pretty much set here. So, but that's new, way early in my career, until I realized how really just a poor decision that is, trying to self-insure. So perhaps one of the toughest objections to overcome is this: why can't I just self-insure? Again, we've never really done a PowerPoint on this, believe it or not. But especially for those high net worth clients, that's where it gets tough. They feel like, But really, the high net worth ones are really a great one to talk to because they can just use, qualified funds instead of having to actually use their own money. And I'll talk about that in a little bit here. But okay, so why can't I self-insure? So just at the start, what clients are saying when they're self-insure, what they're really saying is they don't understand that risk yet. They don't fully understand what we're talking about. And so self-insurance as a strategy it routinely fails in extended care scenarios. Self-insurance is not passive. It creates downstream financial and family consequences. Home care, as we know, can run 5,000 to 6,000 a month. Skilled nursing facilities can run 8,000 to 10,000 a month. Assisted living is 5,500 plus per month. So a typical 3-year self-insured event routinely is going to exceed 200,000. Let's just say 200,000 for round numbers. Okay. Most retirees are planned for income replacement, but not a prolonged 6-figure withdrawal. Large unplanned withdrawals from your portfolio does at the risk of portfolio failure and a sequence of return damage. Unexpected withdrawals can come with penalties, increased tax consequences. So at the end of the day, this unexpected withdrawal can end up costing a client a lot more than the 200,000 they spent. With the fees, broken apart portfolios, the cost of this could be hundreds of thousands of dollars to break down just to get that 200,000 out. So the goal isn't just to avoid bankruptcy, it's to avoid dismantling a lifetime of planning. This is why, again, the self-insuring thing is, do you really want to do that? Okay. So and there's also the family impact. And I talk about this a lot when I sell long-term care. The financial risk for folks is really one of the least motivating factors. They know their kids are taken care of, their kids are grown, they have good incomes. And what's really important to folks is the ability to age with dignity. They want to have choices and independence. They want to avoid burdening their children. Their children have families to their own to raise. They're coaching a basketball team or a soccer team. They've got things going on over the summer. Maybe they don't live close by. This relying on the family is something that a lot of folks and families just don't want to do, right? They want to have some choices. They want to be able to age at home. So the hidden cost there, knowing that 70% of extended care is provided by unpaid family members, primary caregivers average about 20 to 30 hours per week, 60% report reduced income and career disruption, emotional strain, caregiver burnout. Fractured family dynamics are common. This is such a big thing. I think right now we have 50 million unpaid caregivers in this country, about 1 out of 6 of us. You throw out the kids and the people that need the care, it's about 1 out of 3, 1 out of 4 adults are currently caring for an aged parent or loved one. So, and these folks are trying to juggle, careers and taking care of mom and dad. So self-insuring doesn't remove the cost. It transfers it to your spouse and children. Not a great plan, in my opinion, but okay. So let's just take a look at another angle of self-insuring. There's calculators out there we've had over the years, and I couldn't get my hands on those. They're very sophisticated with future value. So I'm going to try to dumb this down for you, but let's just look at, self-insuring versus buying a long-term care policy. If you see on your screen here, this is just a 60-year-old couple. So I got them $200,000 worth of insurance with 3% inflation. So the premium for the male at age 60, $23.97. So he's buying $200,000 worth of coverage. In 20 years, that $200,000 will have grown to $361,000. Okay, so that's where I'm getting these numbers from. All right, so let's take a look at this. So the guy wants to sell, because sometimes you hear this. What if I just took that $23.97 and I put it in some kind of investment? And then in 20 years from now, that'll be X amount of dollars that can pay for my care by itself. Yeah, but what would you actually end up with? So, or what kind of return would you need to get to that 361,000? So 200,000, an LTC policy with 3% compound inflation leaves you with a total of 361,000 in 20 years that I just showed you. All right, to self-insure, that same $2,397 per year for 20 years, that means you put in $47,940. What type of rate would I need return to establish to get myself to 361? Well, it's 19.8%. So, again, that's if they're getting 20% return on their stuff over a 20-year period, I want to know who their financial planner is. I want to invest with that guy. All right. So typical benchmarks, we're talking about 4 to 6%, balanced 6 or 8%. If you're really aggressive and some long-term debt, you might get 8 or 10. But so if you just say that you were really good and you got 8%, you still have to put in 78, 89 per year for 20 years to get to that 361. So what a long-term care policy is going to do, it's going to leverage that money. With long-term care plan, every dollar you put in, you're getting about 4 back. Now, sometimes we talk about short-term care again, which is less expensive than long-term care. I can get a $200,000 pot with inflation with short-term care for close to 1,600. So we do that, you'd almost have to get a 32% return to equal what you get with an extended care plan. So the premise of this here is when people sit there and say, I want to go ahead and just instead of paying premiums, I'm going to put that money in an account, in an investment, and we'll just use that money to pay for it. Well, they're going to come up woefully short, right? There's just no better way to get a leverage on your dollar than the premium. And obviously with long-term care insurance, remember you get your tax deductions, etc. So, okay. And then a quick break-even analysis is something we show a lot in PowerPoints or a lot in our presentations or for the client to see. And so if someone were to buy $100 a day benefit, this is a short-term care, Omniflex. So the annual premium that with the RX rebate, $439 annually, all right? So in 6 years, they paid about $2,700 in premiums. It only take them 27 days to get all that money back. Either in a home care or assisted living or a nursing home. Or if they had this policy for 15 years, they're up there around 6,500 they paid in, just 2 short months. Stroke, heart attack, hip replacement, knee replacement, knee surgeries, what have you. So it's a pretty quick way to break even. So there's a lot of value in short-term care. All right, now, so the self-insuring thing, there's just a lot of flaws with it. It just doesn't work. It's going to cost that person a lot down the road, again, with penalties, withdrawals, burdening the family, and all the other. Okay, but then also there's the high net worth clients, right? Now these again, and I'm not going to go into the actual products here because we do have, like I mentioned, we've got life and long-term care hybrid policies. We've got annuity policies. Sometimes in the hybrid, someone can just buy a extended care policy, and then whatever that premium is going to be, 4,000 or something for a married couple, or 6,000 for a married couple, they're going to pay it for 20 years. I can just go ahead so they're going to spend 120,000. I can standalone second to die life insurance policy for 120,000, and that way they're going to get all their money back. So that essentially that ends up costing them nothing other than the opportunity cost of putting the money into a life insurance policy. So lots of ways to do this, but for those high net worth ones, the nice way to do this is tell them, look, we don't have to write us a check. We don't need to go into your wallet. Why don't we just repurpose some of this money that's sitting there, right? So let's tap an IRA, not the wallet. Again, the high net worth people love this kind of stuff, right? So again, I'm not going to go deep into the details of how these products work. We're going to do a webinar, I think it's in the middle of June, on the different products, the hybrids, how to use qualified funds and reduce tax burden and all that. So it's more involved for today's topic, but we are going to do in there. But essentially what you're doing is, the deferred annuity, you're leveraging those annuity dollars to pay for your care. So you're just taking basically money from one pocket, put in the other, and now this pocket can be used. And the neat thing is when you do this, like with an annuity for an individual, you can insure both spouses, on one fund. So, pull a couple $100,000 out of your retirement, or maybe $100,000 out of your retirement. You get bonus, you get all these dollars. And the nice thing is, and this is something that's been around since 2006, kind of went into effect in 2010, but the Pension Protection Act is an incredibly powerful thing. It's overlooked by so many folks. What it says more or less is that I can use some of my qualified funds, some of my investments, some of my portfolio can be used if it's going to be used for long-term care needs. If I'm in a nursing home, assisted living, or if I'm paying for long-term care insurance premiums, or so any withdrawals out of these IRAs, Roths, 401ks, if it's being used for qualified long-term care expenses, you pay no taxes. There's no burden on that. So just as an example, if someone had, I don't know, they have 100,000 in an annuity. Now they invested this thing for 25 years. They real dollars to them, they put about 30,000 into it, but it's grown to 100,000. Okay. So you could put this in one of these qualifying annuities, a long-term care annuity, if you will, and they'll bonus that at 25%. So now I take that 100,000, I put it in there. Now I got $125,000, and I can use all of that for my care. Now that $70,000 growth that I've had in that thing, I got to pay taxes on that, right? At some point, R&D is going to hit me. Uncle Sam's been waiting to get their money. Well, now that's 70,000. You don't have to pay taxes on any of that. And if you're at 25% tax bracket, for example, that's something like what, $16,000, $17,000 that's just out the door. So take advantage of that. Take the money out of the qualified fund. The pension protection allows these annuities to be set up. What a great way to fund those high net worth clients, just basically moving some money around. How to start the conversation there? First of all, just ask your client, do you have any annuities in your portfolio currently? Do you have any concerns about the high cost of retirement, LTC cost, extended care? We know people do, right? If you could help reduce your tax burden and give you an LTC plan without asking for any premium, would you be interested in hearing about that? Great leading question. I tell you what, it'll open some doors for you. And of course, you can show them some 4 knockout questions to see if you qualify. So again, we do have, and we will be doing I think One America's going to sponsor this one, annuity care exchange sales strategy. This is upcoming. I don't think we have a date on it yet, but we're going to try to start doing more of these. I mean, let's face it, folks, there's a lot of money out there. They call it the great wealth transfer. Something like $27 trillion in these retirement accounts for all these folks. And so there's just a ton of this money bottled up in these qualified accounts. And I don't think the folks realize, with pension protection, how they can just move this money around and have a really decent long-term care plan, extended care plan. It won't cost them anything. Matter of fact, it'll reduce their tax burden. So anyways, that's how you kind of tackle those high affluent ones. Now for here, I'm going to turn it over to Mike, because now I have with us today is Mike Johnson. He's a guy that's trained, boy, Mike, he's got to be with us for at least 20 years, 25 years, Mike, something like that.
I've been with you for 27 years.
Yep. So, he's been around and he has trained some of the best long-term care agents that this company has seen over his 27 years. Incredibly good trainer, incredibly great agent himself. So I was talking to him about this very webinar and he said, I like to do this. Like, why don't I invite you on? Have you kind of say, when you get this question, Mike, I'm going to turn it over to you. And I think, Lynn, you're going to probably bring up, let me get out of my thing here so you can share, Lynn. Did you get those? So I'm seeing this: when you retire, you must choose, right? GoldenCare does both. Okay. I'm looking at that screen, Mike. You should be too. So I'll go ahead and let you. How do you, Mike, with all your experience, how do you handle this question when someone says, I want to self-insure? Go ahead.
Okay. Well, first of all, you got so much information. Mine is rather a simplistic approach and understanding their mindset. A lot of people, you got to think like how they got to self-insured. Well, GoldenCare, not only in their whole life, they're trying to grow their money. They don't realize when it comes to long-term care, that is the best program to protect your money. So we say we do both. We'll help you help grow and protect your money. Like I said, this is a more simplistic approach. Next page, Lynn. So when I'm talking to somebody and they're saying they want to self-insure, I just ask them, how much do you plan to put aside to self-insure? The most common number is a couple $100,000.
Yep.
Okay. I think Jeff even used a couple $100,000 example. Then I just simply ask him, what if I showed you a way to keep the money at $200,000 and still have all the coverage for long-term care you need? Well, then I kind of lightheartedly said, well, I've got this magic box, and you just put the $200,000 in. And so now when you have a claim, you take the money out of the box and put it back in your savings. And then your long-term care insurance will protect your assets, your home, and your lifestyle. As you can expect, the plan has waiver of premium, like Mutual Omaha. So when they're collecting, they no longer pay the premium. The interest off of the money, the money's not in a magic box. They're just taking the interest off of it, and they're not touching the principal. Next page, and I'll show you. With long-term care, IOS programs, interest off savings. So what I tell them is generally there are 2 ways to pay for long-term care. Monthly income, using monthly income not needed to maintain your current lifestyle, and interest off savings. And using interest off savings, not the principal. So if they took that $200,000 and used it, the interest, or God showed the interest of 5%, they would grow $10,000 a year. The increasing cost of long-term care would quickly eat that $10,000 up and then start depleting the $200,000. What I'm proposing to you is keep your $200,000, take the $10,000 interest. In fact, in this case, if you just put $100 aside, the insurance would be $3,600 a year, $6,400 would go back into your account, and then your long-term care plan would protect your assets, your home, and your lifestyle. It would not touch any of your principal or any of your normal monthly budget. And I just try to keep it that simple.
Right. And yeah, that so many people do that, Mike. Yeah, like, look, let's just buy an annuity that's going to return me, 5-6%. And I'll just use that to fund it, and that way we'll use the insurance company's money, not my money.
Right.
Right. Yeah.
Keep
I
it
mean, that,
simple so they don't get wrapped up. The magic box is kind of cute because you're moving them over there to yourself savings, and they're not thinking it. You're what you want to do is for millionaires, it doesn't seem, but a lot of people might have $1 million in the bank and it's 8,000 a month. Okay. And they say, well, I just can't, because the only thing they're thinking about is their 8,000 a month. And we live off that 8,000 a month. Okay. So what you got to do is create another budget for them. By having them use the interest off their savings, you've created another budget for them. Okay. So it can apply in 2 or 3 different cases, but showing them their numbers will wake them up. They go, oh, I didn't think about that. Like I just saw the CPA the other day. He said, I never thought of just using it like that. I was going to do it out of my normal monthly budget. So you got to make sure their mindset is open to these possibilities.
right. Plus, they're picking up a tax deduction on that long-term care premium. So you
Right.
could even add that to their actual interest or their return, because now they're reducing their tax burden on top of that 5% they're earning. So,
Right.
they're winning on both sides.
That's
So
all I got to say about
well,
that.
there's
Somebody
yeah,
got a question.
there's lots of ways to do this, Mike, and thanks for sharing that. Especially for the high net worth people, it's just a matter of moving money around. We're not asking them to write us a check. Okay, so we have to be creative when we're talking to these self-insure people. First of all, kind of tell them how it doesn't kind of work. There's a lot of pitfalls in there. I was kind of trying to get so muddy. We talk about taxation and different tax brackets, and boy, I could give you some stuff that would it confused me. Let's put it that way. It gets to be very muddy. But just a basic concept Mike's sharing here is, let's just redistribute some of your current assets in such a way that let's fund this without having to have cost you anything. Whether that is, again, buying a life insurance policy to refund all your premiums back, putting in an annuity to have the annuity then fund that long-term care, take your tax deductions. So it's that next level for the high worth. Yeah, go ahead, Mike.
Yeah, you can take the approach that, your whole life you've been growing money. When you turn 65 and retire, or anywhere in that, 60, whatever age we are, and you start to retire, your investments, unless they're just, I guess, 100% guaranteed, there's a risk. In your 60s, it's hard to replace it. You got to get in the mindset of protecting your money and trying to grow your money and solve all your problems.
Right. And with 90% of couples are going to require long-term care, this isn't a question of if it happens. This is when it happens. You have to expect this is coming. There's just no way around it. You might be one of those 10% couples that's really lucky, but let's face it, that's not the case. We don't tip over and die anymore. Modern medicine saves us. We used to die from strokes. We used to die from heart attack. Nowadays, people live, and I hate the word, but they linger, and that could be very, very expensive. And it's very easy to create that need, but then we're just talking about how to fund it. And so I don't have a whole lot else here. I wanted to keep it around a half hour. I would open it up to questions. I think I can get to these, Lynn, if you want to help me. Let me see if we have any here.
I'm not seeing any submitted through the chat just yet, but if anybody has questions, they certainly can.
Right. Well, I encourage you, like I said at the beginning, and I say this so sincerely, this isn't a hobby of ours. This is our careers. All of us here are very passionate about, the extended care market. We're all very well versed, and we're just anxious and willing and ready to help anyone wants to call. Whether you have that high net worth client, or you've got that client that's on an extreme budget, maybe they just want to get a home care plan only. Maybe they have some health concerns. Maybe they're a business owner, and we want to maybe do an executive carve out, some type of C corp or an S corp, and have the business pay for it. No matter what you're running into, whatever health concern, whatever budget concern, whatever clients you have, I know this, they're wanting to do something about the extended care. We're going to help you with how to and all the products you need to do it. But you got to pick up that phone and call us. Here's the rest of the team here. It's not all of them, but a lot of folks you'll be working with. and we're all ready, willing, and able to help you out with any questions you have. So with that, I want to thank Mike for coming on and sharing your thoughts there. And I want to thank everyone else for coming on today. We sure appreciate our agents, and we had a decent class today. So you will get a copy of this PowerPoint. Take it for what it's worth. I know we didn't get into the really nitty gritty of these plans, but there are lots of ways to do this, whether, again, it's a life insurance or annuity or investment. So give us a call. We'd love to talk with you. 800-842-7799. Remember, all these great tools that we have are at goldencareagent.com. With that, I'm going to go ahead and say goodbye with everyone. Thanks a lot for coming on board, and look for that one that we're going to sponsor with One America, showing how to use qualified funds. We probably have a nationwide one coming up as well. But we really want to kind of give you guys more of these tools, because the hybrids and these type of stuff is something that the average long-term care guy and med sup guy or some of our agents, they don't get into them a lot, and they're not that hard. And so we're going to try to make these easier for you guys, so you guys can pick up some bigger premiums and help out those high net worth clients as well. All right, with that, I want to thank everyone. Do we have a date? I saw you circling something in there. It says
Late
for
June.
late
I tried.
June. Yeah, now I can't see any of it. No.
I
Yeah, so
know.
that's coming up sometime in late June, but we'll get the schedules out and let you guys know. So with that, everyone, I want to thank you guys for coming on board. Thanks, Mike. Thanks, Lynn, for the help on this. And good luck selling out there, everyone. Give us a shout if you need help. Thank you.
GoldenCare is always here to serve you with new tools, new products, new ideas, and new innovations, and always the best support in the business to help you succeed. So give us a call at 800-842-7799 and check out our website at www.goldencareagent.com.